If you're moving to Dubai from the UK, one of the most common questions is what happens to your UK tax filings and reporting obligations. In this video, I'll explain to you what you still need to file, what you can stop doing, and how to stay compliant even after you have left the UK. This question comes up all the time in my consultation calls with British clients. And the truth is that moving abroad doesn't automatically break your UK tax ties. If you do it wrong, you can stay liable for the UK tax even if you live full-time in Dubai. So this video is going to be very important if you plan to move to Dubai from the UK. Before we start, my name is Shiraz Wahid and I've helped hundreds of entrepreneurs move to Dubai and eliminate their taxes legally. And if you want my help in setting up the UAE licensing, residency and banking, and also help you with exiting your home tax system, then you can book a strategy call with me at setupiro.com/call. Now coming back to the topic, when you move to Dubai, you're not automatically exempt from the UK tax. HMRC doesn't go by your location. They go by your residency status under something called the Statutory Residency Test. This test is a series of rules that determine whether you are a UK tax resident or not. It looks at how many days you spend in the UK, where do you live, where you work, and what ties do you have to the UK. It's not enough to say that you live in Dubai. You must meet the conditions to be treated as a tax non-resident for the tax purposes. To break UK tax residency, most people need to limit the time they spend in the UK to under 90 days, depending on personal connections like family or past residency. This number varies based on your history and the ties to the UK. If you fail this test, HMRC still considers you a UK tax resident, and even if you are living overseas. Assuming that you do meet these rules and become a non-resident, here is what is going to happen next. First, you will need to file a self-assessment tax return for the tax year that includes your departure date. This covers all UK income and global income up to the point that you live. It's usually done at the end of the standard UK tax year. You can also include Form P85 with that return. This form tells HMRC that you have left the country and claiming non-resident status. It helps them update your record, and while it's not always legally required, it's highly recommended to avoid confusion. After that, your filing duties depends on what income you still have in the UK. If you still earn rental income, UK dividends or pension, you may still need to file a UK return each year. But here's the key difference. As a non-resident, you only pay UK tax on UK sourced income. Your Dubai income, your foreign dividends, and anything else you earn overseas are no longer taxed by the HMRC. Let's talk about capital gains. If you sell shares, crypto, or a business after leaving the UK, those gains are generally tax-free under the UK law, as long as they're not from UK property. If you sell UK-based residential and commercial property, capital gains tax still applies. This is one of the reasons some people time their exit strategically, especially when selling assets. There is another important concept of domicile. Even after becoming a non-resident, you may still be UK domiciled, which means your worldwide estate could be subject to UK inheritance tax when you die. Changing your domicile is a complex legal process and takes time. Simply living in Dubai does not change it. And that's why some clients choose to set up offshore structures such as trust or holding companies. These help reduce inheritance exposure and help you keep your assets in a clean legal framework, especially if you plan to stay outside of the UK long term. You also need to watch out for active UK ties that can accidentally trigger the residency. For example, if you keep receiving a UK salary, contribute to UK pension, or remain a director in a UK company, HMRC could argue that you still have ongoing responsibilities and financial presence in the country. This is where it's crucial to review not just where you live, but how your income and company roles are structured. If you run a UK company, consider whether it's better to move management and control to Dubai. If the company continues to be run from the UK with board meetings, decision-making, and major contracts signed there, it might remain a UK tax resident even if you live in Dubai. Once HMRC accepts your non-resident status, you may not need to file a return at all, unless you continue to have a UK income. That's why it's important to properly cut ties and stop triggering new income sources from the UK. The benefits of moving to Dubai is huge from tax perspective. There is no personal income tax, no capital gains tax, and no tax on dividends. But to enjoy that fully, you must exit the UK tax system cleanly and build your Dubai structures the right way. You also need to consider practical things like informing your bank, updating your national insurance record, and reviewing estate plans. The more you have been active in the UK, the more steps are usually involved in cleaning up. So if you want my help in building a clean structure that ends your UK tax filing and get you set up legally in Dubai, you can book a strategy call with me at setuphero.com/call. And if you're serious about moving to Dubai and want to protect your income, investments, and business for long term, you can check out my next video right here.